In this lecture, I am going to explain what are the general entries of the current liabilities. So I will be going to explain what are the non-liabilities and why need working capital management and what is working capital management. And there I will be going to explain some of the general entries, for example, the payroll expenses, sale taxes, which is also known as PST, Provincial Sales Tax, unearned revenues, accounts payable and not payable. So first of all, I'm going to explain that what is the meaning of working capital management and why this is so important. So it is very important for the restaurant and retail businesses to keep business going smoothly. Companies need sufficient cash flow to cover day-to-day operations of the business or day-to-day purchasing obligations. The company will not be able to run its operations for a long period of time if it does not create enough cash flow to pay for the cost of buying goods as well as to pay for the current portion of debt payments and other commitments. So what are the known liabilities we have? When companies knows whom to pay, when to pay and how much to pay, these liabilities are called known liabilities. Following are the liabilities. The first one is the payroll, then sale tax, unearned revenue, accounts payable, and the last one is notes payable. I will be going to explain all these liabilities with one example in the upcoming session. See, the first one is the payroll liability. Payroll liabilities are employees' compensation amount owed to employees for work performed. It means the work is performed in the business. Services are already done and we have received. For example, the owner has received services from the employees, but some of the money is due but not paid. Right? For example, the CPP is Canada Pension Plan, EI Employment Insurance, all amounts withdraw or legally required to be remitted by the employer to the appropriate authorities. It means whatever the amount that you have kept from the employee's salary, right, CPP and EI, this is the legal obligation on the employer to pay off these obligations, these expenses to the appropriate authority. So this is known as payroll liabilities. So now I'm just going to explain what is the difference between the gross pay versus net pay. So net pay is also known as take home pay. The difference between an employee's gross earning and deductions taken equal to an employee's net pay. For example, on January 10th, we have the following payroll information. For example, the gross payment is 2200 and we have some deductions. EI premium 35, income tax 278, medical insurance 110, CPP 105, union fees $50, and the total of all these deductions, that is 578. So 2200 is the gross payment, means gross salary minus all the deductions, like that is the 578. The remaining amount will be the take home pay, which is also known as net pay, that is 1622. So what is the general entry for all these deductions and gross payment? So you can see that the salary expenses are like 2200 here, right, which is known as the expenses of the company, which falls under the nominal account. The rule for this is debit all expenses and losses and credit all income and gain. So this is the expenses of the company, so we have put on the debit side at the time of making the journal entry. So the expenses, this is of expenses nature. When expenses increase, we always debit. This is the rule in the golden rule of the debit and credit, the personal, real and nominal. So the second one is the 2 EI premium payable. It means employment insurance premium was due but not paid. Income tax were due but not paid. Medical, CPP, unit fees, and even the salary was due but not paid. So all these expenses that we have put it together on the credit side. So this is how to make a journal entry for the first one, that is for the payroll. Now the one more example, it says that employer portion of the tax. Now that was the employee portion. The employer portion of tax is also one of the liability for the employer. So how to record employer portion of payroll taxes? For example, employer also contribute employment insurance and CPV. So how much and how many times that is to be contributed by the employer? So EI is contributed one time of the employee's portion, for example 35 into 1, and CPP, that is 1.4 times of the employee portion, that is for example the 105 into 1.4, so 147, that will be contributed by the employer. So here is example. The general entry for this transaction would be EI expenses 35 to EI payable. It means which due but not paid. So this is the record of employer portion of employment insurance. CPP expenses 147 and 2 CPP payable 147 here. So this is the record of employer portion of Canada pension plan. So these are the expenditures that they have to do it, right? They have to make the payment of all these later on. So that becomes the liability of the organization. The next liability is the PST, right, which is known as sales tax or provincial sales tax. It is a tax applied on sales to the financial or final goods or final consumers of the product. For example, that if I have bought laptop, I'm using that laptop, right, for my own purpose, not for the business purpose. If someone has taken the grocery from somewhere, maybe from the superstore or Walmart, they are consuming those items or those commodities, right? So those are customers are known as consumer, means end users. So this means that the business does not incur PST on its purchase, right? So PST is calculated as a percentage of the sale price of the item being sold. For example, the sale amount is $6,000 and 7% of the sale is 420. This is the sale tax that we, as a owner, we collect from the consumer. All provinces or states collect PST from their consumer or a customer and forward this tax periodically to the appropriate provincial authority. So here is one of the example. I'm just trying to explain the PST, right? With a one example here in front of you. Consumer purchasing from RJ Private Limited. A laptop is used by the final consumer or a customer, right? And will therefore pay the applicable PST. Our company is required to collect and remit PST. Remit means to submit the PST charged on the sale to its customer. If RJ Private Limited laptop's total cash sale was $6,000, the company would record the following entry: the 7% on the sale. And if, for example, that we have the cost price of all those laptop is $4,000, so general entry of this transaction would be cash that we have received 6,420, including the PST, to laptop sales to PST payable. And one more general entry that we will create, because that the $4,000 is the cost of goods sold, right? So cost of goods sold account debit to inventory stock. So why inventory stock is credit? Because the inventory in the store or in the office has declined or decreased by $4,000. So that's why this is that we have put on the credit side of the journal entry now here. And this is the cost of goods sold, the expenses we can say. So expenses is the nominal type of account, debit all expenses and losses in this case. Next, we have one more example. When RJ Private Limited remit or forward this tax to the taxation authority, the general entry will be PST payable account debit to cash. Right? It means to record the remittance of PST payable $420. It means in the previous transaction, the taxes was due but not paid. But at the time when the taxes are paid, taxes means I'm talking about the PST, sale tax. So sale tax account debit means PST payable account debit to cash. We assume that the payment is made by cash, right? So the cash will come on the credit side here in the journal entry. Next, what will be the effect of these transactions on profit and loss count and balance sheet? So on the profit and loss count, there will not be any effect, but on the balance sheet, on the liability side, you can see that the PST payable will comes under the current liabilities. Next, if we talk about the taxes, the GST is also one of the tax. So GST is what? This is the goods and services tax. The federal means the central government, sometimes we say, levies a goods and services tax, which is known as GST, and this is a kind of tax on nearly all goods and services sold in Canada and is charged to the end consumer. The GST rate is in the most of the provinces is 5%, and some of the items and some of the sectors or services are GST exempted. What are those? Educational, health, and financial sector, on which the GST is not applicable. So PST general entries and GST general entries, that will remain the same. The method is also the same. Now, what is the input tax credit and what is the meaning of ITC? And before understanding the input tax credit, we should know what is the meaning of a registrant, individual or entity selling a taxable supplies that is responsible for collecting the GST on behalf of the government. So the registrant is the one of the person, just like we are the human being, and maybe the name of the company, right? So company or a human, in case of as you can say sole proprietorship, the owner of the business, right, collect some amount of a GST on the behalf of the government, and later on the GST will be paid by the registrant, right, and on purchase of taxable supplies. So input tax credits are applied against the GST payable. So input tax credit is equal to GST receivable. So what is the meaning of this? Input tax credits are applied against the GST payable. So GST payable, it means that we have received those taxes. Definitely we will pay those taxes to the appropriate authority. On the other hand, that we have given the GST at the time of purchasing of some the taxable supplies. So the difference between two, that will be remitted to the appropriate authority. I'm just going to explain the same concept with the help of this example in front of you. So remitted amount means the GST paid to the government. For example, when goods are sold and the GST is collected, for example, this is $100. Now input credit is what? Input credit is GST receivable. It means GST was paid at the time when the company bought some goods or supplies from the suppliers. When you're going to buy something, definitely you will pay GST on that particular amount. You have paid some GST, right, at the time of buying, and when you sold some goods, that you received the GST. So difference between these two will be remitted amount, that is $25 here in front of you. This is an excess amount that will be payable and paid to the receiver general of Canada. Sometime what happen, there may be a refund from the receiver general of Canada if input credits are more and GST collected is less. Now one example is in front of you. On April 3rd, RJ Private Limited purchased $10,000 of merchandise inventory, for example some electronic items, for selling on credit from the Samsung company, and term will be 30 days. So GST, we know that is a 5%. So RJ Private Limited record this transaction as follows. Merchandising inventory means purchase account debit $10,000, GST receivable 500, and the account payable Samsung, that is 10,500. For example, that we have bought some goods, right, from the Samsung company on credit. So definitely the entry will be purchase account debit to Samsung company, means account payable Samsung company. If we have collected the GST, definitely that we will write the GST amount here, GST receivable, right? So GST receivable that we have written here. So in this case, it means that we have paid this amount like 500 that we are going to pay at the time of buying some goods, right? So that's why we say the GST receivable. This is the amount that we are going to pay to the Samsung company maybe later on, but after then we will receive this amount and adjust this amount when we sell it. So record purchase on credit plus applicable ITC, right, input tax credit, that's $10,000, and 5% that is $500 here. In the next example, on May 6th, RJ Private Limited recorded a total sale, that is all cash, no any bank or no any check transactions. So the amount is $35,000 and the cost of the sale is 23,500. Let's see what is the transaction uh, of this company. So cash we have received, that is 36,750, to sale 3,500,000. So then next is the to GST payable, that is 1,750. So record cash sale plus applicable GST, that will be 5% on $35,000. That will be 1,750. So next will be the cost of goods sold. That is the expenses of the company. So these expenses will be considered as the nominal and debit all expenses and losses. So it will be debited 35,000, and the stock has gone down to merchandise inventory. That will be 35,000 here. So in these transactions that we have sold some goods. So once the goods we sell maybe on cash, so we receive some cash. When we are selling goods, not only the cash we have received, but also we have received cash against the taxes as well. On the sale, 5% it is tax, 1,750. This we have received from our client and on the behalf of the government, and definitely we will pay this money to the government. So that's why this is known as GST payable. Previously, it was GST receivable at the time of purchasing of the goods, right? So the difference between two, that will be remittance, that I will be going to explain the same thing in the next page. Look at this. After posting the May 6th transaction, the GST accounts shows the net balance owing to the Receiver General of Canada of 1,250. So how it is calculated? The GST payable was 1,750 less GST receivable, or we can say input tax credit of 500. The difference between these two, that we will pay to the Receiver General of Canada. Let's say that RJ Private Limited remitted the balance to the Receiver General of Canada on May 7th. The entry to record this transaction will be GST payable account debit 1,750 to GST receivable 500 to cash 1,250. So in this, what happened? The GST receivable and the GST payable, they were adjusted automatically, and the rest of the amount that we have paid, right, excess amount that we have received in the form of taxes, in the form of GST, that definitely we will pay to the government. Next is unearned revenue. This is also one of the current liabilities. Unearned revenues are almost all those amounts that are received in advance from the customer for the future product or services and are reported as current liabilities. For example, one car dealership, or you can say renting car company, that if they received some security deposit, that will be also become the liability, because at the time when the client come back and return the car, and they will take money from the company, right? So it has become the liability for the company to pay the amount which is already they have taken the form of securities. And unearned revenue is also then, like for example, that some of the company they just received money in advance for services to be rendered in the future. That is also known as unearned revenue. The revenue which is not earned this year till 31st of December is known as unearned revenue. Unearned revenues include advance ticket sales, for example, for the sporting events, music concert, and airline flights. So when our company received something in advance, but the services are not provided till 31st of December, for example, or if on the quarterly basis till the end of the quarter that we have not provided the services to the client, but we have received money for that particular period, this will be considered as current liabilities. So this is unearned revenue. For example, we can assume that on 31st of March, RGA Private Limited receives advance of $5,000 for providing services in future. It means services is not yet provided but will be provided in future, but we have received that money. No doubt if we have received that money, so cash balance will go up, because cash account debit which is in real nature, and debit what comes in and this is the current assets that will increase. And we will credit the unearned revenue, which is also known as advanced services, $5,000. Right? This is the personal credit to the giver, and this has become the current liability of the company. So this is a general entry that we have done and to record the revenue on deferred performance obligation. Next example is in front of us. For example, on May 15, RJ Private Limited provided services to client of $3,000. When services provided to the client, income will be generated. So the credit service revenue with that amount. So what do you mean? It means already in the previous example, the 5,000 was the credited, right, for the unearned service revenue. But actually we have provided the services to our client for $3,000. It means the advanced services we will debit with that amount to service revenue, which is our actual income. So actual income is the gain. So credit all income and gains that comes under the nominal account. And this is the what happened. This is you can say these are the income of the company, and income is increasing. Next we have accounts payable. It can also be the nature of the term responsibility. So term means some maybe 60 days, 30 days, or maybe 90 days period, or maybe more or less. It all depends upon the supplier as well as the consumer in the business to business dealing. And the term responsible for all outstanding money a business owes to its suppliers, and account payable to the company's creditors for the purchase of goods or services on credit. And also we can say what is account payable. Account payable is considered as the short-term liability of the company as well. Now I'm just going to explain the same concept with this example. Let's say on July 10th, RJ Private Limited purchased inventory or sometimes we can say goods from the Costco $6,000 on credit. It means definitely the entry will be purchase account debit to accounts payable Costco $6,000. Purchase is what this is expenditure and nominal account or debit all expenses and losses. The expenses are increasing. On the other side, accounts payable on Costco, that is the personal credit the giver current liability is increasing. So the entry will be purchase goods on credit. Now we have bought some goods and money is not yet paid. Let's see. In this example, that $1,000 that partial payment that we are going to pay. So account payable Costco, that was the liability. Now the liability is decreasing now when we debit it, right? So accounts payable Costco account debit 1,000 to cash $1,000. So cash has gone from our business, so credit but goes out under real account rule. Next is note payable. So transaction will be exactly the same as the account payable. But what is the difference between these two? Note payables are some written obligations, right? Let's see. So note payables are the typically uh, interest bearing to compensate the suppliers or issuer of the note for the time until payment is made. A common use of note payable is in the purchase merchandise inventory and other assets or replace an account payable. What is the meaning of this? Like replacing of account payable. If there is an account payable, right? Let's say that we need to pay some money. We need to make some money or payment, but we are not paying on time. And we ask like, is it possible that we can pay later on, maybe for after 6 months or maybe 9 months? So why why they like the people we keep the money right with them and will not make a payment? For example, I have bought some goods from the suppliers, right? So I keep that money for a long period of time without any interest, right? So they will not tolerate this one. They need like there may be some percentage on that particular amount. Along with that amount you will pay some interest on that amount as well. So that is known as note payable. Sometimes we can say the current note payable also arises when the money is borrowed from the bank. I'm just going to explain this concept with the help of one example. Look at this. On November 22nd, RJ Private Limited asked to extend its past due $5,000 account payable to Costco, and Costco agrees to a 60 days 12% $5,000 note payable to replace the account payable. So RJ Private Limited records this transaction as follows. We know that in the previous example, we bought some goods on credit. That's $6,000, right? So purchase account debit to account payable Costco. That was the entry. But now what I'm going to do, account payable that I'm going to clear and not payable that I'm going to increase. It means the conversion of account payable to not payable with a 12% rate of interest per annum just for 60 days period. Let's have a look. Account payable Costco account debit 5,000 and to note payable Costco account 5,000 on the credit side. It means 60 days note to extend due date on account. Now for the 60 days, right? But here we can see that on 31st of December, RJ Private Limited incurred interest on the note 39 days from November 22nd to December 31st, which is recorded as follows. So now interest that definitely if we pay interest to the company to any party, so that will be the expenditure of the company. So interest expenses account debit to interest payable. It means interest due but not paid on 31st of December. Accrued interest expenses that is calculated the $5,000 into 12%, and we know that in 1 year there are 365 days, and for 39 days that if that amount is used on the basis of that amount that we have calculated 64.11, that is the only interest expenses for this year, but due but not paid, that's why that we have credited interest payable. Next we have the note payable, right? So note payable that we are making some examples. So one of the example is that from the TD bank that we have borrowed some funds on 12%. So let's have a look. A bank requires a borrower to sign a promissory note when making a loan. It means TD bank, right? TD bank is providing loan to the RJ Private Limited, our company. It means the RJ Private Limited borrowed cash with 60 days 12% 1500 note. The borrowing company, let's say RJ Private Limited, records is the receipt of cash and new liability with the following. Cash account debit $1,500 which is given by the bank will debit, current assets has increased. To note payable, here I'm not writing the account payable, here I'm writing the note payable TD bank. Why note payable? Because that note payable that we have written it, right? This is the promissory note. We have put signature somewhere on the paper on documents that this is that loan that we have taken for 60 days and definitely we will pay 12% rate of interest. So what will be the effect of this entry, all these transactions that we have done in the previous slides? Note payable Costco $5,000, interest payable 64.11, and note payable TD Bank that will be $1,500. So all these will comes under the current liabilities of the balance sheet. Next, we can see other current liabilities also occurs and that have in the counting period of 12 months. Let's take an example of the vacation benefits. Many employers offer paid vacation benefits or paid absences. Assume that the salaried employees earn a 2 week paid vacation per year. So it means the expenses due but not paid. It means accrued expenses is unpaid expenses, and this is also known as accrued liabilities. So there are more expenses which are due but not paid, similar to this one. Uh, the first one is the employee bonus expenses. Whatever the treatment and the general entry we will do for the vacation benefit, exactly the same kind of journal entries that will be recorded in our books of accounts. And unearned revenue or gift card and estimated warranty liabilities. All these are the liabilities, and the same treatment and same general entry will be done. But I'm just going to explain the one that is the vocational benefit. Look at this. On 31st of December, adjusting entry to record $1,400 into 2 weeks, right? So that is 2,400 of accrued vacations benefits. The following will be the general entry for this. Vocational benefits expenses account debit 2,400 to vocational benefits payable. This is the liability of the company, and the first one that was expenses of the company. Expenses of the company will be coming on the debit side of the profit and loss account, and the vocational benefit payable that will come under the current liability of the balance sheet. Now, what we have learned? We have learned in this lesson that the current liabilities are due within 1 year of the balance sheet, and these are the current liabilities that we have learned. Payroll liabilities, PST, which is known as Provincial Sales Tax, unearned revenues, right? Money that we have received, but that is not belong to that particular period, right? So, because the services that we have not provided, accounts payable and not payable.